Hello and welcome to the DIY Investing YouTube channel. Today we are covering Home Depot, ticker HD. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. First up, this company has a market cap of $331 billion, enterprise value of $370 billion. So you can see about $39 billion in net debt on this business. Overall, that's a little over 10% of the enterprise value, so it's not a very significant amount on the overall company. Industry is in the specialty retail business. So Home Depot is in a home improvement retailer. I have been to many Home Depots. It's actually a really great place where you can buy building materials, home improvement products, lawn and garden products, decor, facilities maintenance, repair, and operations products. This is an important business because they target both residential homeowners themselves as well as the professional renovators, remodelers, contractors, maintenance professionals themselves. So that's really key. They definitely have those two different segments. You can tell when you go inside these stores, there is definitely the one targeting consumers directly, and they're targeting the actual remodelers themselves. You can buy wood, you can buy all the tools you need, everything along those lines. So you have the DIY and you have the professional all together in the same store. These are very large format stores. They're very popular in the areas that I'm used to, and very interesting to dive into this business. Share turnover of 95%, beta of 0.94, so it's only about 5% less volatile than the average S&P 500 stock. Now let's get down to the return on invested capital. And the first thing I see is I'm very excited about this chart. This chart shows me two things very quickly. You have 20 straight years of profits. Every single year is above the 0% line, so we can see profitability every single year. The lowest year of profitability was return on invested capital of 7.49% in 2009. Now that makes sense that basically the Great Recession, the decline of the housing market, you would have a decline in return on invested capital, and they went from 20% down to 7.5%. But they immediately came back, and they only spent 2 years below the critical 10% marker. I like to have 10% or higher return on invested capital, and only in 2009 and 2010 during the recession did they have those marks. By 2011, they were back at 11%. And then the cool second thing that I see in this return on invested capital chart is the steady incremental improvement year over year, getting consistently better return on invested capital. So you go 11%, 13%, 15, 19, 23, 25, 28, 30. 39% in 2019 marks the high, 37% 2020, 2021 was 32%, then 36 and 36%. So over the last 6 years, they have been above a 30% return on invested capital chart. It is hard to understate how incredible these numbers are. These are world-class numbers. This is not simply a high-quality company. This is an exceptional business. These types of numbers are amazing, and you can see that when you go to the 10-year median returns. You have a 31% return on invested capital, 73% return on equity. Again, you only have 10% of the enterprise value as debt, but that's enough to boost the return on equity to 73%, return on invested capital of 31%. Amazing numbers. What this is telling me is any money that can be reinvested in this business is worth doing. All of the retained earnings are getting incredible returns on capital, and you're going to want more and more of that. If the company can grow, you want that. If the company can reinvest, you want to do that. If they can find a way to grow their money organically, you would want this as a shareholder. Very strong numbers here. Now, also, you're saying that this can basically self-fund all of their growth. They don't need debt in order to grow. Return on invested capital, return on assets are showing that because both of these numbers exceed all of your growth numbers here, 767 and 18% EPS. Now, the EPS number growing substantially faster than revenue and assets is partly because revenue is growing faster than assets, and partly because you're going to have some operating leverage in this business. And you can see that when we go down to this number, you start out the decade at 11% operating margin, you end at 15%. That is that operating leverage so that your revenue is growing while at a pretty good rate, 7.7%, and that's going to double your revenue every decade, 78 billion, 157 billion. Your earnings per share is going to more than double, and this is actually almost a 5x EPS growth over the course of a decade, which is just incredible, $3.76 to $16.69. So very good numbers here. High quality business by far. I'm getting very excited looking at what we can see from a quantitative basis. Now, the PE valuation ratio and the PB ratio here gets very interesting. When you see a price to book of 914, that immediately leaps out like, what is going on? But there's a very good explanation for that. And I'm sure when we get to the balance sheet and when we get to those income statements to really look at buybacks is going to be a big here. I'm going to guess there's a lot of buybacks. And if you make buybacks above book value, what that does is that's going to drive down your actual book value because of the mechanics of how that buyback works. And if you're doing it substantially above book value, it will just continue to increase. So I'm guessing they're doing a lot of buybacks and they've been consistently doing it for a long period of time. That's the only way you're going to get a price to book number like this when you still have reasonable price to equity, price to sales numbers. So P&S 2, price to equity of 19.8, let's call it 20. So the PE of 20. Now, I like to target buying above average companies for average or below average prices. Average prices would be like a PE of 15. This is clearly an above average company, but it's not just an above average company. It's an exceptional company, exceptional business, and exceptional high quality businesses tend to be pretty reasonably fair valued at a PE of 20. Sometimes that could actually be undervalued, but I would never want to pay above 20. And so I'm thinking this company is probably reasonably priced, maybe even undervalued depending upon how we look at these growth rates. I mean, if they could repeat this growth rate on EPS, then even paying a PE of 20 makes this company substantially undervalued. You think about what this means is you're starting with an earnings yield of 5%. You're growing your revenue at 7%. So you say, okay, we got 5% plus 7%. That's a 12% potential return on your investment when you just say revenue plus starting earnings. That's actually a really attractive number, and I like to see that. We also see that they are paying a dividend. This dividend is growing really strongly, and we can see that we've basically running the dividend almost at 40 to 50% payout ratio compared to your earnings. So if we just say, okay, we have a PE of, you have 5% earnings yield, maybe, we say that's 40%, you're going to get 2% from your dividend. So you say 2% plus 7.7%, you're looking again at almost a 10% return simply adding dividend plus revenue. So we're getting a really nice, reliable way where you can get a 10 to a 12% return easily without a lot of assumptions on future operating leverage. If you get operating leverage and you can turn 7% revenue growth into 18% EPS or 10% EPS, 15% EPS, you're going to get incredible returns on this business while having the reliability and sustainability of profits every year for 20 years. So very exciting on the numbers basis here. You can just see incredible returns on assets, incredible returns on capital, very impressive numbers. So I like what I'm seeing there. Gross profits being pretty stable, right around 34%. The more stability you see on a gross profit margin, the better the business tends to be. That means it's very predictable. 34.2, 34.1, 34.2, 34.2, 34.0, 34.3, 34.1, 34.0. If you've seen a lot of my videos, I encourage you to watch more of these videos, but if you see a lot of my videos, this is not normal. This gross profit margin being this stable over a 7-year period means the company has the ability to price their products exactly where they want and maintain incredible stability of those margins. And when they do that and they continue to grow, they've been able to incrementally increase their operating margin despite maintaining a very clear gross margin. In fact, their gross margin on the last year is lower than it was on the first year, and your operating margin is 4% higher. Very impressive management of this business. Very exciting things from Home Depot so far. Let's go to the income statement. If you're enjoying this video, if you're learning something, hit that like button. Don't forget to subscribe. Let's continue. So you can see cost of goods sold, revenue, again, gross profit margin hitting very clearly. So I'm not going to spend too much on that line item. One of the key things here, though, that you can see is they grew revenue by 2x, right? So we went from 78 billion, 155 billion. Great. They doubled over the course of a decade. That's like your 7.5% growth. Did they double their SG&A? No. So they were actually able to go from 16 billion in SG&A to 26 billion in SG&A. If they had doubled it, it would be 32 billion in SG&A. That extra $6 billion dropped straight to the operating profit line. It's very impressive. So instead of simply doubling, they doubled their gross profit, but they were able to almost triple their operating profit because of that. And then you get additional leverage because, of course, in 2017, you had the Tax Cuts and Jobs Act. So then the actual rate at which you paid taxes went down. That's why when you can see in 2018, you see this 13.7 billion in pre-tax income. They paid 5 billion in income tax. But 2019, 14.5 billion in income. They paid 3.4 billion in income tax. Part of the reason for that is, of course, you're paying a lower tax rate because of those tax rate changes. So you're getting operating leverage between pre-tax income and net income. that would be unlikely to repeat in the future because you'd have to assume a further cut in the corporate income tax. Is it possible? Yes, but I wouldn't rely on that when predicting the future. However, you can probably rely on the fact that they've been able to get this operating profit to have some operating leverage here because they were able to maintain their SG&A at that reasonable rate. Can they repeat in the future? It's harder to say. I don't really like to plan on having operating leverage growth, but it's really good, nice to have when you see the history here in that number. The other thing that's really adding to our EPS growth is you're having buybacks. I mentioned you're going to have buybacks pretty regularly. You went from 1.4 billion shares outstanding to 1 billion shares outstanding. You've basically shaved somewhere between 30 and 40% of the shares outstanding off in the last 10 years. That's going to add an extra, 3 to 4%, 3.5% to your EPS growth rate simply from the buyback. So now we're going to say, okay, we got a 7%. Again, let's go back here. So you got 2% dividend, you have 7.5% growth, you're going to have 3.5% from your buyback. And so you can quickly see how you get to those really nice double-digit returns, 12, 13, 14% returns, even without repeating some of the operating leverage steps. So it's a very attractive business when you can quickly see pass to double-digit returns, not just a 10% return, but you're starting to hear those 12, 13, 14% numbers. That's really where you get that alpha, and that's where it gets really exciting as a shareholder. So let's look at assets. We're talking about high returns on assets. One of the things here, again, you can see PP&E. This is a big number here that I want to focus on, PP&E and inventory. So your inventory, did a little bit more than double. Your PP&E is only up about a third, 33%. So your overall assets didn't fully double. So this is key because, you started out the decade with 41 billion in assets and you were earning income statement operating profit of 9 billion. So that's what, almost 20% type returns on things. You now have operating profit of 23 billion on assets of 76 billion. So that's a huge increase because you've gone from that, sub 20% to now you're in the 30 to 35% range for the operating profit to total assets. That's including some of the goodwill. If you're just focusing on PP&E and inventories, which I think are the key numbers you'd want to worry about here, you can see that the returns are even better than that. You're getting closer to 50% type returns on those those incremental assets. And so that's really good numbers for continuing to grow over time. That makes sure just everything looks good when you have this upward sloping return on invested capital chart. Very stable, very reliable, very good numbers. You do have long-term debt. The long-term debt has 4x over the course of the decade. What that means is they're taking on more debt than they maybe need to. They can self-fund all their growth, so why are they taking on debt? What that's doing is that's helping them to boost their returns. That's what's really making the difference here of going from return on invested capital of 31% to return on equity of 73%. It's what's allowing them to get all these share buybacks because they're basically using that debt to complete share buybacks. They have enough cash coming in to self-fund all their growth. When we get to the cash flow statement, you're going to see that. So why are they taking on the extra debt? It's basically a booster. It's helping to get you even more returns than your earnings on its own necessarily would. It is a little bit of risk, but it's one way that the industry is able to boost those returns. And how can I know that? Well, you see this cash flow from operations number, 7 billion here, 14 billion here. It substantially exceeds all of these, non-cash things. You have depreciation, amortization. There's very little working capital changes, very little PP&E expenses. They don't have the ability to reinvest all their money. So they don't need to take on debt in order to fund their business. They really don't do that. They're able to actually take on that debt to fund some of these buybacks. They're able to be more aggressive on their buybacks, more aggressive on their dividends because they're able to take on their debt. They're taking advantage of the difference in the cost of capital between their company taking on debt, 3, 4, 5, 6% interest rates. They're able to pay it out to shareholders who are looking for double-digit returns. And that spread is boosting your return as a shareholder over time. Very attractive numbers. Overall, clearly well managed. Do they need that extra boost? Not necessarily. If they change it, fine. It's not going to be a big deal. But overall, everything here with Home Depot is impressive. This is a company with 20 straight years of profits. Very reliable, very strong, growing returns on invested capital. World-class numbers, 31% return on equity, 73% return on equity, 73% return on equity, 31% return on invested capital. Extremely stable gross margins mean the business is being managed extremely well. Very high quality moat from these numbers. and it's trading at a reasonable or potentially even cheap price. I already mapped out a way where you can see a clear path to double-digit returns if they can maintain this sort of revenue growth. So that's very attractive to me as a potential shareholder. Home Depot is going on my watch list for those reasons. I hope you learned something. Hit that like button. Don't forget to subscribe. And if you like this software that I'm using, quickfs.net, the link is in the description below. That's my affiliate link. Please consider using my link to sign up. You can get a free or paid account. And it's a great way to support the channel by using my link because I get a commission if you sign up through my link. Thank you for listening. And until next time, stop paying fees, start building wealth.